Let's move on to the profitability ratios. As said, profitability ratios can be divided into two categories. One will have what is known as general profitability ratios. Then we can have the overall profitability ratios. What we'll do in general profitability ratios is we will compare various profits with sales. So in general profitability ratio, our focus is we are going to compare various profits with sales, and we are also going to compare various profits with various items. So it is not only confined to sales, but we are going to find various profits, and that is going to be compared with various items, and that will help us to understand in what direction this organization is going. And in overall profitability ratios, what we'll do is we will compare the profits with investment. This is the ratio which investors will be looking for. Because when you invest in an organization, you will be interested in knowing what is the return you are getting from the investment. And for that, you basically have to look into the profitability ratios, which are overall profitability ratios. So understand, in general profitability ratios, we'll be comparing profits with sales and with many other factors. Whereas in overall profitability ratios, we are going to find out different sets of profits, and that are going to be compared with investments. So in this session, I'm going to take you through what are the general profitability ratios. So let me put it here. General profitability ratios. In general profitability ratios, our first ratio can be gross profit ratio. I'll write it as GP ratio. The first ratio is gross profit ratio. So gross profit ratio is nothing but we will compare the gross profit of the business with the net sales of the business. So this ratio will tell us what is the gross profit we are making out of sales. And this information is very much relevant or very much required, because it is only from gross profit you are going to meet other expenses of the business. So now automatically a question will come to your mind, what is gross profit? It is very simple. Gross profit is nothing but sales minus cost of goods sold. That is, for selling the goods, you will be incurring certain cost. So whatever is the cost of goods sold, that should be subtracted from sales. Then you will get a gross profit. Then from gross profit, you have to subtract all the indirect expenses, and that will help you to find the profit. So understand, if you want to find profit, what you have to do is from sales, you have to subtract the cost of goods sold, then indirect expenses. So that will give you what is the net profit. But if you want to know what is the gross profit, you just have to subtract what is cost of goods sold. So what is cost of goods sold? Cost of goods sold is nothing but the direct cost which are incurred in manufacturing the goods, or say rendering the service. So what is direct cost? Direct cost can be split into direct material cost, that is the materials which were purchased for manufacturing this particular product. It can be the direct labor cost. I mean, you are engaging laborer for producing or manufacturing this product. Then it can be direct expenses. The other expenses which were incurred directly with the operating activity, that is the activity of generating sales. Then we'll call all these as direct expenses. So apart from direct expenses, you can also have certain expenses which are directly related to the cost of production. So all those will go into the cost of goods. So here I would like to add some, say, admin expenses which are relevant. If you don't incur these admin expenses, then you cannot complete the production process. Okay, so all this will go into the cost of goods sold, and if you subtract this cost of goods sold from sales, you are going to get the gross profit. And if that gross profit is compared with sales, you are going to get what is known as gross profit ratio. We'll also call it as gross profit margin. Just to give you an example, let's say you have made sales of $100 million. Okay, you have made sales of $100 million, and your gross profit, let's say it is going to be $60 million. Your gross profit is $60 million. So now automatically you can find what is your gross profit ratio, which is nothing but 60 divided by 100 into 100, and that is going to give you the gross profit margin, which is 60%. That is, if you produce and sell these goods, you are going to make a gross margin of 60%, and it is from this 60% you have to meet your other indirect expenses. You have to meet what is known as overheads. It might be slightly technical, don't worry about it, but it is only from this gross profit you have to meet your other expenses. Okay. So let me move on to the next ratio. The first one is gross profit ratio. We'll move on to the second ratio. The second ratio is nothing but operating profit ratio. Or before covering operating profit, let me give you what is operating ratio. Operating ratio is nothing but comparing the operating cost of your business with sales and arriving at a percentage. So this ratio, operating ratio, the formula is operating cost divided by net sales into 100. So this will give you what is the operating ratio. So now you will have a question, what is operating cost? Operating cost is nothing but cost of goods sold plus other operating expenses. So whatever other operating expenses which are incurred, then that should also form part of operating cost. So what is other operating expenses? It can be your admin expenses, it can be your selling expenses, it can be your general expenses. So all these three will go into the operating element. So this means that in your business you can have some non-operating cost. That is the cost which does not go into your operation, but still you would be incurring that cost. And to understand, simple example is interest on loan. Interest on loan has nothing to do with your operation. It is because of your financial decision. So interest on loan is a non-operating cost, right? So when you factor the operating cost, keep in mind you take only those costs which are operational in nature, ignore the non-operating cost. So you have to arrive at what is the cost of goods sold, what are the cost of other operating expenses, so that you will know what is your operating cost, and compare this operating cost with sales so that it will give you a major insight. Now just to give an example, let's say the cost of goods sold is $60 million and your other operating expenses are $20 million. So this means that your overall operating cost is $80 million and let's say your sales is $100 million. If your sales is $100 million and your operating cost is $80 million, then this would give you the operating ratio as 80%. This ratio is going to be expressed in percentages. So if your operating cost is $80 million and net sales is $100 million, then your operating ratio is going to be 80%. Your operating ratio is going to be 80%. And this ratio communicates that your operating cost is 80% of your total cost, right? Or I would not say that it is 80% of your total cost. What I'm meaning here is from your sales, 80% of the sales goes to meet your operating cost. It means remaining 20% is available. That 20% may be available for meeting your non-operating cost, and it would be available for giving you some profit. So operating ratio will tell you what is the operating cost incurred by the organization and what share of sales is available for meeting the non-operating cost and the profits. We also have some more ratios and in general profitability ratios, which we'll see in the next session.